We have a lot to cover here. Kevin Green is with me. He's watching all the levels. Good morning to you, Kevin Green. We're starting off with some slight green after yesterday's inflation print and also some Fed speak this morning, too.
Yeah, if you're kind of looking at the economic calendar, not a lot on the agenda here today outside of the Fed speakers. As you kind of talked about, maybe a little bit of weakness when you're looking at market breadth here. We do have a couple of sectors in the green here so far, but they really are on the economic expansion type of sectors that are actually performing. Energy, materials, and industrials really kind of leading the way for now. It seems like there's a lot of rotation that's taking place in the morning. But overall, as you kind of talked about throughout the morning here, it has been very bullish. We've made some really good gains over the last couple of weeks, and the market's really looking for that to really continue here. That 5,900 level is still going to be an area of resistance for us. We talked about this one yesterday. We actually did see a little bit of a break above that 5,900 level, getting to around 5,906, and then we saw a failure going into the close, which is fine. We have another day today to try to break through here and try to make some incremental gains. But if not, and we do see a breakdown in price for whatever reason, we still have this blue line, that upper end of resistance that is now going to turn into support to be able to leverage in order for the market to really kind of bounce off of. And you're looking at around 57.50 there. So even if we saw around a 100-point move to the downside here today, I don't think it would be actually a negative thing for the market. And once again, having some upside potential here when it comes to market breadth, if that's going to continue, that's going to be favorable for the bulls. On an intraday basis, once again, looking at 5,900. To the upside, 59.40 could be your area of resistance if we're able to break through this current level here. And any type of breakdown, I'm looking at 58.25 here. This is going to have to be really news-driven in order for us to get a significant fade to the downside. But we might be in this type of market as well, Nicole, where we just see kind of compression or maybe more range-bound trading activity like we saw yesterday. Well-defined ranges to the upside, downside, and we kind of trade within that range. And that's okay. A consolidation for a day or two is also pretty favorable. So overall, we're looking pretty good, holding up a key area of resistance here. Some structural positioning at that 59.05 level. I'm really keeping my eye out on that as we go into monthly options expiration on Friday to see how this level 5,900 actually does resolve itself.
Oh, yeah, and that'll bring some those expiration when you have whatever it is, triple witch or whatever, it's going to bring some heavy volume too when you have options expiration. What's interesting too, as you noted, the 5,900 level right there again. Yesterday we were bumping up there, sort of knocking on the door, and we got to see whether or not we can get up there and stay above some of those key levels. You're also watching gold right now down $50 today. What is important there in that story?
Well, for the gold trade right now, we are at let's say a make or break moment when it comes to the gold trade. We've seen obviously a really strong run here over the last year or so. And right now we might be in a situation where we have a double topping pattern taking place. You can see that MACD actually crossing a bearish formation, still above the zero line, but a bearish formation with that 12 EMA below that 26 EMA here. And we are approaching that 50-day moving average. That's going to be in that yellow line here, that 3163 level. Looking for some buyers to really step in. Are we going to continue this trend to the upside for gold, which has had a really great run? If so, that 50-day moving average has been a key area of support that we've been able to consolidate and break above, over the last year or so. You can see it within that chart. RSI, once again, we had a bearish divergence that took place, especially when we looked at that April 21st, April 22nd high, and now that bearish divergence is kind of following through. I don't think everything is said and done when it comes to the gold trade. We've seen fake outs before, where we see heavy selling taking place, more of a risk on tone in the market, getting out of risk off type of assets here. But this is actually a very critical area that I'm looking at seeing being resolved here. And if we actually have a breakthrough to the downside of this 50-day moving average, Nicole, and it's on significant volume, you can make the case that maybe that 3,000 or even that 2,900 level on gold could be in the picture over the next couple of weeks, if not months here. So very good trade. Seems like some profit taking is taking place here, but from a technical standpoint, you would say that this could be a bounce zone for gold futures.
Right, understood. And so now, last but not least, I also want to take a yield curve. Some thoughts there as we're seeing the 10-year yield, by the way, at 449 today.
Yeah, so we actually are going to be looking at the 30-year, 10-year Treasury spread. I had somebody reach out yesterday and said, hey, are we concerned about what's happening with the 30-year? Because the 30-year Treasury is almost hitting at around 5%, hitting that 5% mark. Is it a concern right now? And I would say, no, it's not really a concern. It's the rate of change between the spreads that really does matter. And obviously, we've seen a decent re-rating to the upside or a normalization of this curve, but we are not seeing a complete disjointed move when it comes to the 10-year and 30-year. Is the 30-year hitting that 5% or going to exceed 5%? That might be the case, Nicole, but you'd like to see actually a normalization in the yield curve in general if you are looking at an early cycle type of market, getting back to the basics when it comes to the economic growth within the United States. And I think as long as the spreads themselves are kind of moving in unison across the curve from the 2-year to the 5 to 10 to 30s, I think you're okay. I don't think there's a warning sign here. The warning sign would be a move to the upside for the 10-year, equities moving lower and dollar moving lower. That's sell everything or sell America trade that people were talking about 2 weeks ago, 3 weeks ago, a month ago. That's not in the cards right now. I think this is a healthy normalization when you're looking at the back end of the curve here. I would not put this on the radar as a potential risk. It's going to be a problem when it comes to government funding because it seems like Scott Bessent really wants to target the 10-year, 30-year portion of the curve here. It'll cost us more money, but when you're looking at it from a trading perspective, normalization is actually good and healthy for this market.
All right, Kevin Green, great to see you. Thank you so much.